Welcome to the Manitoba Ag Days podcast, where we hear from some of the most relevant, up-to-date, informational speakers in our industry. In episode 43, Edith Friesen, business advisor, Taxation Services, MNP LLP, shares her story. How will recent tax changes impact the farm?
My name is Edith Friesen, and I work for MNP here in Brandon. I'm a tax specialist at MNP, and I've been a tax specialist for about 8 years. And I've worked with MNP for about 13 years altogether. I'm not going to lie. The day the proposed legislative changes came out, July 18th of 2017, I was in the US on vacation with my family, enjoying the last 2 months I had of maternity leave. I was blissfully unaware of the impact that the proposed legislation would have. When I returned to work in September, I couldn't believe how much impact those proposed legislative changes would have on the advice I give clients on a day-to-day basis. So what happened last year, and how will the proposed legislative changes impact my farm? The consultation period began on July 18th of 2017, and it went until October 2nd. And I'm pretty sure everybody saw some kind of article or heard about it in the news, or maybe they attended one of our presentations to hear about how these changes were going to impact tax in the future. So from October 16th, from July 18th to October 2nd, there was a whole consultation period. And when I returned to work in September, my colleagues were out beating the ground, trying to make sure that everybody was aware of how the changes were going to impact the family farm and corporations in general. We were pretty scared, to be totally honest, and nervous about how we were going to plan for the future. On October 2nd, the consultation period ended. On October 16th, which was pretty shortly thereafter, the government started to release the results of the consultation process. On October 16th, they talked about a reduction of the small business limit that would be moving forward. So the small business limit is going to go from 10%, which was enacted on January 1st of 2018. It'll go down to 9% on January 1st of 2019. And they backed away from anything they talked about regarding the capital gains exemption. And the capital gains exemption, I'm going to talk about a little later, but it's very important for farmers. On October 16th, they also indicated their intention to continue regarding the tax on split income. So if we're sharing income with family members via dividends, the government took real offense to that. And so on October 16th, they came out with their Toastie rules, or their tax on split income rules, and I'm going to talk about those a little later on. And then on October 18th, they confirmed that they were going to move forward with any proposals regarding passive investment income, and provided a few details on how that would be implemented. And I have a slide to talk about that as well. And then on October 19th, they talked about how they will no longer be moving forward with measures relating to converting income into capital gains. Now, that one I'm not 100% sure about. I think that in the next budget, there's going to be legislation that closes the loophole on converting income into capital gains. So if you are in the middle of a transaction where you're converting income into capital gains, I suggest you finish it up as fast as you can, because I think at the end of March, that loophole is going to close. So I went through the legislation, and I went through our presentations, and I thought about what are the top 11 things that might affect our clients or farmers in general. Those things are the transitions to children, transitions to a spouse, anything that has to do with the capital gains exemption, asset transfers to partnerships and corporations, sale of land to a corporation, sale of partnership interest to a corporation, any wasting freeze transactions, any preferred shares that we've given to non-farming children, any dividends to family members, the deferred grain ticket issues, and then how are they going to treat passive income in the future. If you have any questions, can we answer questions along the way, or are we saving it to the end? Do we have to save it to the end? Okay. Okay, so how will the proposed legislation impact transitions to children? And we were pretty worried about this, because every family farm wants to be transitioned to the next generation. Excuse me. One thing that came out of the consultation period, I think, was that they backed away from hampering the ability to transition the farm to the next generation, either in your lifetime or on death. This has not been impacted. This includes the transfer of any farmland, any shares of a family farm corporation, or any interest in family farm partnerships. Now, keep in mind, there are separate rules for each one of these assets if you're trying to transition them from yourself to your children, and there are different rules if you're going to do it in life versus death. So if you're thinking about doing this, please be sure to contact a tax specialist. We need to go through all the details before you make a mistake that could hamper your ability to do this on a tax-free basis. And once again, the transitions can be done anywhere between cost and fair market value, which can greatly affect how the transaction is taxed in the future. Transitions to a spouse. So transitions to a spouse remained unaffected as well. The proposed legislative changes did not hamper our ability to give things to our spouse. However, the rules before the proposed legislative changes are not well understood. These types of transactions are easy to do. Most of the time, you just have to meet with a lawyer and make a change on a document, and I'm going to use land as an example because it's probably the one we see the most often. Clients will go to their lawyer and they'll move land or an asset into joint ownership with their spouse. We usually do this, or we usually see people do this in order to avoid probate, and it's probably a good mechanism to avoid probate. But one thing you have to keep in mind is because you gave half the asset, half that land to your spouse at cost, any income produced from that land in the future actually attributes back to the original owner. So if that land were to generate rental income, you can't split the rental income with, I'm going to say wife because typically it's husband gives to wife. You can't split that income with your wife. If you were to sell that land, you can't split the capital gain with your wife and share and use her capital gains exemption. The whole gain attributes back to the original owner. Spousal attribution is not, we call it spousal attribution when everything reverts back to the original owner. It doesn't often get caught by CRA, but if it does get caught by CRA, the tax consequences could be dire. When possible, I would suggest that land be purchased in both names, or if you're considering transitioning land to your children, that you give it to both your child and their spouse. Now, that comes with a whole host of other problems, because once you give land to your children, the land becomes their property, and they can do with it what they like. So if they choose not to farm it, if they want to sell it and party, then there's really nothing you can do about it once the title has changed. So that's just something to keep in mind. The capital gains exemption. So on October 16th, the Department of Finance announced that it would not pursue the proposed measures that would limit access to the capital gains exemption. And the capital gains exemption is a way that farmers or individual taxpayers in Canada can shelter a gain when they sell property. And so depending on the type of property sold, that will determine how much capital gains exemption you have available. Most folks in this room would be looking at $1 million capital gains exemption because they would be looking at selling something that is qualified farm property. If you were selling something that wasn't qualified farm property, that was potentially qualified small business shares, your capital gains exemption would be limited to $848,000. So when we're talking about farm property, really kind of what we're talking about is land, the shares of a family farm corporation, or the interest in a family farm partnership. Like I said before, there are separate rules depending on what type of asset you're transferring. So you have to be very careful, and whether or not you're doing it in life or death. Once again, please seek tax advice and don't just do this at a lawyer's office, because we want to make sure that your tax plan makes sense for you now and into the future. Selling assets to a partnership or corporation. So traditional structure planning for farm operations will often include a transfer to from a proprietorship, or like a sole proprietor individual farmer, into a partnership, and I'm going to use husband and wife because that's typically what we see. And then after a period of time, then we would go to a corporation. Or we might skip one of those steps, but those are the 3 steps that are usually the most tax efficient: proprietorship to partnership, partnership to corporation. The proposed legislation, and more recently the Department of Finance announcements, will have an impact on the ability for the farm operation to be converted to a partnership or corporate structure. Will not. They backed away from anything that has to do with capital gains exemption. They backed away from it. This is not going to affect this tax plan. So this still remains the most effective way to structure your farm into the future. Before the proposed legislative changes, there were 2 sort of concerns that we have when we're transferring someone into a partnership, and those still exist today. The first one is having significant deferred grain tickets. If you've deferred grain as a sole proprietor, as an individual farmer, when you go to partnership, there's no way we can transfer those deferred grain tickets into the partnership. So you're stuck with those deferred grain tickets on your personal tax return, and you'll have to pay personal tax on that. So if you're thinking about getting into a partnership or thinking about going to a corporation, you might want to start thinking about how you're managing your deferred grain tickets. The second issue we see quite often is if you have debt that is greater than your tax cost. And tax cost is just tax lingo for undepreciated amount of capital assets plus optional inventory. So if you have more debt than you have tax cost, it's not, or if you have deferred grain tickets, it's not that we can't put you in a partnership or can't put you in a corporation, but we can't do it on a tax-deferred basis. So if you're thinking about changing your structure, it's important to come talk to us, and we'll help you figure out how to get into that partnership or corporation in the most tax-effective manner. Like I said, significant tax benefits can be made if we do everything in the proper order. Sale of land to a corporation. I'm not certain how many folks in here have sold land to their corporation or have rolled land into their corporation, but I was literally having a heart attack when I thought about the fact that we would no longer be able to roll land into a corporation. In the recent announcements, they've also backed away from this. So my presentation has lots of good news. Most of the things that they had proposed they have sort of backed away from. The use of the capital gains exemption to complete this transaction is no longer a concern. Some of the scenarios we would see where we would transfer land into a corporation would be if you have lots of cash inside your farm corporation and you'd like to get it out to do some fun things personally, like maybe you're ready to build a new house, or maybe you want to go on vacation, or maybe your child's getting married and you need some cash to give them. Any of those things might be facilitated by rolling or selling land into your corporation and taking back what's called shareholder loan, and then shareholder loan can be extracted from the corporation tax-free. A second scenario where we might do this is sort of the opposite, where you've pulled a ton of cash out of your corporation to do some fun personal things, and now you have a shareholder debit balance. CRA doesn't like it when you owe the company money. They consider that to be salary that has not been declared on your tax return, and so they'll only let you leave it outstanding for a short period of time. Typically what we would do is we would roll land into the corporation in order to clean up that shareholder debit balance. As I said in the previous slide, sometimes when we're going to partnership, we might have a debt problem, like debt is higher than our tax cost. If we were doing that transaction and the farmer had land, we might consider rolling one parcel of land into the partnership. That parcel of land will increase the tax cost, and now rolling to a partnership is no longer a taxable transaction. We've now done it on a tax-deferred basis. And sometimes we would do it for succession planning. Maybe we want to give different corporations to different children, so we'd roll the land to the different corporations and then just leave the corporations to the children in the will. These measures were impacted by Section 246.1, which brought into question the ability to sell land to a corporation and utilize capital gains exemption. Like I said, they've backed away from 246.1. Now, I feel like I've been talking about land all the time, and farmland is an important tool that we use on a tax in my tax practice. But if you're going to come to a tax advisor and you want to talk about your land or transitioning your land to your children or rolling your land to a corporation, we need a ton of information about that land. And I've been doing this for 8 years. Every single time I go back to a timeline and I draw a little line on a piece of yellow paper and I say, okay, land acquired in this year by whom? Like by granddad typically. And then what happened to the land sort of step by step. When was it acquired? How was it acquired? Who farmed it? How much did they pay? If you've acquired it, who did you acquire it from? Did you purchase it from somebody? Did you and your wife purchase it from somebody? Did it come as a gift? Was it left in a will? How was the land reported on the tax return of the person who passed away, who gave you the land? Because that could actually save you tax money. It could actually save you taxes in the future if we used their ability to step up the cost base. Who owned it? And by that, I mean, did you own it solely? Did you own it with your siblings? Because the way the tax legislation works is children are okay, siblings are not. So if it went to you and your siblings and then you bought it from your siblings, then it might not qualify anymore. So all those little details are so important when we're doing an analysis of land. So before you see an advisor, please gather as much information as you can. I actually sent a lady back to small town coffee shop here in Manitoba to ask around to see if anybody there knew what had happened to her father's land. Because both of her she was in her 70s, both of her parents had passed away, and she was uncertain as to what the history of the land was. Oh, sorry. Sale of partnership interest to a corporation. Like I said, this is a big tax tool. It's the best way to get the most tax-free dollars out of your corporation. And we do that by rolling to a partnership, and then we have to let 2 years pass, and then we can sell the partnership interest to a corporation and get a big shareholder loan, which gives us the ability to extract money from the corporation on a tax-free basis. Once again, 246.1 was terrifying because this is probably 90% of our tax practice. And the thought that we wouldn't be able to do it, I thought was going to actually hinder the ability of farmers to operate. There is still a bit of uncertainty. The new legislation for the tax on split income has come out, and it is going to impact the ability to do this in minor ways, but the principle of rolling to a partnership and then to a corporation still exists, and it's not going to be impacted by the proposed change to legislation. Wasting freeze transactions. So I'm not certain if anybody's ever done this, but sometimes as we age, we decide that it's time to pass our farm along to our children. And so we're looking at a tax-efficient manner to do that. One of the things we might do is we might talk to mom and dad and say, hey, how much do you think you're going to need to retire? Once they figure that out, and we've done this transaction for years, and so once we figure out how much they need to retire, then we might do a freeze where we freeze their value, we take back their common shares, and we give them fixed value preferred shares. And the thought behind that is we are going to, as the corporation, redeem those shares over time in order to fund their retirement. The repurchase of the shares or the redemption is actually considered dividend income to mom and dad. And in this new Toastie legislation that was enacted on January 1, 2018, we think most of the time dad is going to be okay, but we are sort of worried about mom. The rules around Toastie are still coming out, and and we're not 100% certain of them, so I just want to warn you that the Toastie could impact this transaction. But essentially, the reason I'm worried is because when we've done these freezes in the past, we've always considered that mom and dad would have access to graduated rates. Well, if Toastie is enacted, or if somebody is subject to Toastie, then they're going to be taxed at the highest marginal rate, which is about 47%. So that significantly impacts how much money mom and dad will have left over when they retire. If they have significantly less money than anticipated to retire, we might have to do some more tax work for them. M&P is in constant conversation with the Department of Finance with respect to this issue, and we're hoping that we're going to get it resolved pretty quickly, but that's the biggest impact to our tax plans right now, is the Toastie legislation on the wasting freeze. Not unlike the wasting freeze, preferred shares for non-farming children has been a way that we have split up the estate of mom and dad for years and years. So a non-farming child might get some non-voting preferred shares, and the farming child is okay with that and agrees that when mom and dad die, then I will redeem those shares over time in order to get you what you deserve out of mom and dad's estate. Once again, if the Toastie legislation is enacted, or if Toastie applies the way we're scared it will, then that non-farming child may end up with a higher tax rate because it will be taxed at their highest marginal tax rate instead of a graduated rate over time. So we might have to look at some other solutions. Maybe we have to refreeze or re-look at how much each child is entitled to. We might have to give other things to the non-farming children. Maybe somebody gets a car or diamonds, I'm not sure. Or one of the most efficient solutions, I think, would be a joint life insurance policy, last to die, which would bring in some cash into the corporation and give the farming child a bit of cash flow to pay out his or her siblings, to get rid of them out of the corporation. When we think about dividends to family members, this is also a strategy we use pretty often. We like to give dividends to each family member so that we can access everybody's graduated rates. This is the Toastie legislation that I'm talking about, and it was substantially enacted on January 1st, 2018, but the legislation is awful. And CRA is changing it on a daily basis, and we're still working with it, so we're not exactly 100% sure how it's going to impact our clients. One of the things I want you to take from this presentation is that when we pay dividends to family members, they're going to have to be reasonable from now on. And what does reasonable mean? Well, your guess is as good as mine. When we're talking about reasonableness and CRA, one of the things I think we have to think about is making sure that we have everything documented. If you're paying dividends to a child or a spouse, I think you're going to have a job description. You're going to have to make sure that the wages you're paying them or the dividend you're paying them is the same that you would pay to a third party. You should have timesheets. It's all going to be a real big pain in the ass. And I think it's important to consider doing it now versus later. We always have a lot more success with auditors if when they ask for information, if we give it back to them instantly, rather than if we have to take some time and sort of make up the supporting documentation that they're looking for. Passive investment income. This was a huge part of the proposed changes, and they backed away from everything, thank goodness. Essentially what they're saying now is the first $50,000 of investment income will be taxed at a reasonable rate, which would be about $1 million portfolio. So when I think about what does $50,000 worth of income mean, I have a million questions. Is that net income? Is that gross income? What can I deduct from that? Is that per corporation? Is that per family member? Is that per associated group? The guidance they've given us on this passive income stuff is really, it's not even worth the paper it's written on. We really don't know what to tell people about how to arrange their affairs when it comes to passive investment income inside of a corporation. The last thing I'm going to talk about is the deferred grain tickets. We are hoping that CRA is going to back away from any question about deferred grain tickets. They had a consultation process from May 23rd to July 24th. Because they haven't come out with any results from that consultation period, we are thinking that they're probably backing away from making any changes. That being said, if you have big deferred grain tickets, I just want you to be aware that's on their radar. And so if it's an amount that you're not willing to pay tax on all in 1 year, I think you should start thinking about how to make arrangements to get your deferred grain tickets into a reasonable amount of income on an annual basis. So that's basically all I have to say today. If you have any questions, I will be in our MNP booth for a couple of hours here this afternoon. Is there any questions? Sure. Yeah, they've been cashed. There's no, oh, sorry. Right, for cattle producers, the question is for cattle producers, has anything affected the fact that we always have accounted for them on a cash basis? And the answer is no. There hasn't been any talk of changing the way beef producers account for their income or are taxed on their income.
I think I saw a hand over there, maybe not. Nope. Okay.
Perfect.
All right, thank you very much, Edith.
You're welcome.
Frizon.
Thanks for tuning in to the Manitoba Ag Days podcast. We'll see you next year from January 22nd to 24th, 2019.